Good morning, traders. Welcome to this review of the Mag 7 stocks using Ichimoku clouds as well as artificial intelligence. We'll kick off with Apple. What a great rebound rally we've had here from the bottom end of the Ichimoku cloud. We had a fantastic volatility breakout signal there. Generated by the Fulgent AI engine that sits on the Metastock platform. So we literally had a few reasons to do this trade. Yeah, one, we had the AI volatility breakout signal there. We also had a classic cloud chart rebound signal there from the bottom end of the Ichimoku cloud. We also had a rebound from this 144 exponential day moving average. So we had a couple of reasons to do that trade, and also we were busy with a 61.8% Fibonacci retracement. It's quite a deep retracement from a Fibonacci perspective. But after this phenomenal rally where we had two trades up 24, 25 and 17%, we then expected a bit of a pullback consolidation to the 23.6. That happened. Then we had a 38% retracement, and there was another fantastic volatility breakout swing trade on that zone there, and then it met resistance at the standard line of the Ichimoku cloud, and then we were looking at a 50% retracement, and then ultimately the 61% retracement when the taps opened, and it had a huge correction back down to the bottom end of the Ichimoku cloud. So there's a couple of great rules in and around this rebound trade there. And with this rebound trade there, then the upside resistance target was the standard line as well as the top end of the Ichimoku cloud. And then once we break through that, we move our trailing stop loss up there right now. And the upside target is the old high. That's the ultimate target that we're looking at. So up 14.3% so far on that particular trade for June, July-ish for Apple. But that's been an absolutely fantastic trade. The other thing to also notice is this downward continuation pattern. If a move down, pull back, and then another move down. It's almost like they're symmetrical if you look at the distances between the two, if you measure them. But so that also gave us extra comfort to take that high probability trade set up from that Ichimoku cloud chart rebound. So that's a classic one. It's one to really look out for when you're using the Ichimoku clouds. Now, beginning a year for Amazon, we had a couple of nice trades on the back of Amazon, as well as this cloud chart cross to the upside. Then we're looking at this high, and we're looking at a retracement there, and Amazon did once again also similar to Apple, a 61.8% Fibonacci retracement. And that volatility breakout trade didn't work out so well, but this one worked out well because it had a very wide trailing stop loss there. The thing here is we were rebounding from a critical moving average as well as a critical cloud chart support zone. Here you can see lots of water torture in and around this bottom end of the front end of the Ichimoku cloud. Now you could take these cloud chart rebound trades off this bottom end of the Ichimoku cloud with a wide trailing stop, just to accommodate the distance between the cloud and this what's the moving average? Is that one now there? There we go. Hold on. 233 exponential moving average. So we're back above the bottom in the cloud, which is healthy, because generally speaking, once price action takes a price below the cloud, the Ichimoku cloud changes to bearish. We did have somewhat of indication if you look at the twist in the front end of the Ichimoku cloud, somewhat giving you an idea that Amazon is a little bit under pressure now. The easy money was made in this rally in the beginning of the year. We're now consolidating, dealing with a major retracement there, and also with major support zones. So this is level there, 278 is a line in the sand for Amazon at this point in time from this Ichimoku cloud chart perspective. So now this trade, the upside target here is the top end of the front end of the Ichimoku cloud. You can see that resistance zone there, as well as the top end of the Ichimoku cloud where we are just right now. So you can see that 260, these levels are the upside resistance targets for this current rally. But just keep your trailing stop quite tight on this one, because once it dips back below the bottom in the cloud, you probably want to switch out of Amazon. Next up is Google. Another beautiful volatility breakout trade, also together with a cloud chart rebound trade. There you can see how how Google rebounded from this old cloud chart support zone there. And now we're already blasted through the turning line of the Ichimoku cloud and getting very close to the resistance level there at the top end of the Ichimoku cloud. So keep it your trading stop quite tight now. The upside profit target is this top end of the Ichimoku cloud. We really need to see a breakout past that zone. If we get that breakout past the top end of the Ichimoku cloud, we're looking at these old highs as the next upside target. So 400 is the upside target for this current trade. But so far so good. Google it, another similar to Apple, beautiful retracement trade there. Let's just go and look at the Fibonacci retracement there. If I just put an insert. There we go. So if we look at from this move to that level there, and you can see 23, yeah, 38%, yeah, bit of a rebound there, 50% retracement, spot on. So once again, there was an additional reason to take that trade. It was a 50% retracement in Google, right, happens to be right at the bottom in the Ichimoku cloud. So fantastic. So keep that, develop that as a trading rule with trading the Ichimoku cloud. Next up is Meta, bit of a problem child at this stage. We had a couple of really good swing trades there. The current one is still active, but you can see how the cloud is a critical resistance zone. Yeah, every time we get to the cloud chart resistance zone, as well as these moving averages there, 233, Meta is struggling. To be really bullish on Meta, we need to be back above this top end of the Ichimoku cloud. So watch out for that catalyst. As long as it can stay above the bottom in the cloud, the rally should be okay. If we get a breakout past the top end of the Ichimoku cloud, you've got that first level of resistance to deal with. Let me just 632, and then the next upside target is this zone there at 672, and then the further ones to the upside. But we do need to see a breakout past this top end of the Ichimoku cloud, so watch out for that. That's the catalyst you're looking for the cloud chart breakout across the top end of the Ichimoku cloud. Microsoft there is another problem child, similar to Meta, struggling below the cloud. You can see how this cloud chart resistance there is holding up. We've had a few nice volatility breakout trades coming out of it, but now it's stuck below the cloud. It's not in good shape like Apple or Google. It needs to really break past these levels. So the current volatility breakout trade needs to get past this 394, and then once that's done, the next upside resistance target is this zone there at 411, and then we're looking for a breakout past that. What we could see in this move is a rally, pullback, rally, hit the targets, then pull back to the bottom end of the front end of the Ichimoku cloud, and then make another attempt at breaking through the cloud chart resistance. So Meta and Microsoft is something you got to watch out very closely to see if we're going to get a breakout past that Ichimoku cloud. Now NVDA, once again, also struggling a little bit. We had some great trades in the beginning of the year coming out of NVIDIA, but now we had a bit of a consolidation back down to these top end of the Ichimoku cloud as well as the bottom end of the Ichimoku cloud. Now, NVIDIA has a tendency to dip below the Ichimoku cloud and rebound from old cloud chart support level. Yeah, you can see that. Yeah, so it dips below the cloud and then rebounds from previous 190 old cloud chart support zone. So it's kind of within buying zone, yeah, between 190 and the 200 zone. Nice little rebound there. You could have taken all these trades off that moving average test, break through the cloud. That's another good position to be in. That's now a new support zone there, so watch out for that line to come back as a significant support zone. Then we're going to hit the upside to resistance target. There's the standard line of the Ichimoku cloud there, together with the top end of the front end of the Ichimoku cloud, and ultimately that level 220 is the upside target. So we've got a few upside targets for NVIDIA. Let's just take a look at the Fibonacci levels there. Let's insert, yeah, there we go. We're going to look at this move from there to there, and you can see that was on spot on a 50% Fibonacci retracement with a 61% slightly deeper. So that's not, you know, 68.2 61.8% Fibonacci retracement is not the best situation to be in, because that's quite a deep correction, but still we did manage to rebound from that zone. I would much rather have preferred a 50% retracement, 38 to 50% retracement in a strong trend. So just keep that in mind. It is increasing the risk factor in the back of my mind when I trade NVIDIA, but still long at a range between 190 and 200 on NVIDIA, and I've got my upside targets clearly set. Tesla is the next one, another little problem child there. We had some really great swing trades coming out of it, but now a great rebound here from this 377 exponential moving average, as well as the bottom end of the cloud chart shadow. You look back and see where's a significant low in the actual Ichimoku cloud, and then project that forward, and you can see we took great comfort in rebounding this rebound trade, because we had a volatility breakout. We were rebounding from a moving average as well, yeah, and we're also rebounding from the bottom end of the cloud chart shadow. Then broke through the resistance there at the top end of the cloud, got very close to the old high upside target, but then snapped back, and now it's fighting for support here at the bottom end of the front end of the Ichimoku cloud. So now that is a significant support zone to watch out for. We could see swing trades from this level to the upside. If we start trading below this, then Tesla might be rolling over and retesting these lows here, so watch out for that. We're at a critical juncture for Tesla to maintain its upward momentum. They're making higher lows and higher highs to the upside, but we've got our upside targets, 440 there. This significant resistance zone, that's the upside target for a swing trade from this bottom end Ichimoku cloud chart level. Right, next up we'll look at a institutional data review of the StarMine models. Looking at these MAG 7 stocks from a quantitative, fundamental, quantimental basis. And the StarMine models ranks various factors, really deep diving into the fundamentals of a company, valuation, etc. And then it ranks stocks from best to worst. These are personal rankings, so if you're in the top 10-20% of the market, that's good, but if you're in the bottom 10-20% of the market, that's kind of bad, basically. So you've got the bullish and bearish scores for Apple, yeah. We can see there's not much short interest in the stock, but what we like here is the earnings quality rank is 84 per star ranking, and also the credit scores are quite high, so there isn't much of a credit risk here. For Apple, it's basically an intrinsic valuation problem here, as well as price momentum and valuation momentum score here. So these are not a very good scenario. You can see here also where does Apple rank globally in terms of valuations. From a relative valuation perspective. So it's not a relative valuation story. You have to look at it in absolute terms, and just be aware that the earnings quality is good, but the intrinsic valuation at these levels are pretty much challenging. So that's the bull and bear story on Apple from a StarMine perspective. Google, just take a look at Google here. Much better on terms of the ranking side. Price momentum score is very high, so you can expect the price momentum to persist. The analyst revision score is 78. That means the analysts are still very bullish in the stock and starting to upgrade their numbers. Short interest is low. Credit scoring is quite healthy there. It's just that once again, intrinsic valuation and relative valuation scores are on the bottom 20% of the market roughly. So it's not the cheapest stock out there, but on a price momentum score, analyst revision score, so they're still upgrading their numbers, as well as the smart holdings, where we look at the best performing fund managers there. Are they buying it? So that ranking is quite high. So Google is looking attractive on the bullish case there, but it's a valuation concern on the one side. Meta, let's take a look at what the risk factors there. Oh, yeah, it's a bit of a mess here. Not many scores are favorable. The earnings quality is 61. So Meta's got a lot of work to do to improve its earnings quality. It's also got some structural credit risk, and keep that in mind when you looking at it. And also intrinsic valuation, relative valuation, all score very poorly. So from a StarMine valuation model perspective, Meta's got a hell of a lot of work to do still to improve both its fundamentals as well as its price momentum and intrinsic valuation. So you can see there not many favorable models on Meta from a StarMine perspective. Let's take a look at the next one, NVDA. Very healthy there, lots of bullish numbers being upward revisions, where we look at these best performing analysts out there. Are they improving their numbers, and the upgrades and earnings enhancements that's still taking place? Short interest very low. Earnings quality is 83 per star rank. That's very high. It's a very good score there. Credit risk is very low for NVIDIA, so there's still the free cash flow still underpinning its model here. Combined alpha model, very high ranking, so you could expect NVIDIA to outperform over the next year or two. Price momentum score, relative valuation score, very low there, so that needs a bit of a room for improvement. Price momentum score, we've now clearly seen from the price action as it's been moving sideways, correcting a bit, that that is a critical thing to watch out for. Valuation, once again, bit on the pricey side there. But still, once again, we do like these StarMine models. It is number one in its particular space there, so lots of bullish views on the StarMine model. Just be aware that relatively on a global basis, NVIDIA is in the bottom 20 to 30% of the market. So that's one of my favorite stocks, NVIDIA. Microsoft, the other problem child we got there, if we just look at the models here, smart holdings, short interest very low, credit risk is still okay compared to Meta, for example. Insider selling is quite high. They're still selling there. Price momentum score is very low, because you can see it's not having price momentum. It's stuck below the cloud. It's struggling with that, so there's room for improvement. As soon as you start seeing the price momentum score improve, then we should see some better performance coming out of the stock. Earnings quality, TSLA rank of 53, so Microsoft needs to really improve its earnings quality if we're going to look deep into the balance sheet and the income statement at the line by line items as to what drives the earnings growth, and that's how we get to that score. Is not a pretty picture at this point in time. But once again, the intrinsic valuation score, bottom 40% of the market's not very good. So you can see there, mixed bag in terms of valuation. It's not as screaming buy as we say. You have to take a bit more of a fundamental view on it, and then also overlay that with the Ichimoku clouds and the AI. Tesla is the other stock with lots of issues in the earnings quality there, bottom 60% of the market. So earnings quality is very, very poor. There's lots of room for improvement on the earnings quality side. Lots of credit risk, structural credit risk as well. And that's the risk factor there. Intrinsic valuation, bottom 1% of the market, so it's not very attractive from a valuation perspective, as well as a relative valuation also in the bottom 6 percentile ranking. So there are better quality names out there from an intrinsic valuation and relative valuation point of view. Price momentum score is very bad on bottom 13 percentile ranking, but at least on the upside, the analysts are improving and upgrading their numbers. So the ARM score, the analyst revision score, is very high at 95, so they are upgrading and improving the financial figures there. But on a relative valuation rank, it's in the bottom 6% or 10% of the market, so it's a frightfully expensive stock in view of the poor earnings quality you've got here, as well as valuation momentum. Now, interestingly enough, if you're going to do a reverse discounted cash flow, you can with the StarMine data, you can see what is the market implied growth rate. So you can see the markets, there's the stock market, the stock price. If you reverse input the stock price to come out with a growth rate by doing a reverse DCF, it's the market implied growth rate of the current stock price is implying 37% growth. And you can see what the analyst expectations are. Is the smart growth, where we track the most accurate analyst estimates, is about 13% growth compound annually. So you can see huge disparity between what the analyst growth rate, the smartest analyst out there covering the stock, is thinking what it can do long term versus what the market implied. So there's a lot of expectation in Tesla to really deliver the current stock price is discounting 37% growth over the next couple of years, which is like 3 or 4 times the average what the StarMine analysts are expecting. So lots of room for improvement there. But once again, very poor earnings quality. I want to highlight that. So there's a lot of work to be done for Tesla to improve the fundamentals as such. And the last one is Amazon from a StarMine perspective. You can see analyst revision score, they're upgrading the numbers there. Smart holdings is high rank there. Short interest is very low. Credit risk, it's 79 percentile ranking. That's okay. Earnings quality is very poor. So once again, yeah, earnings quality is bottom 13 percentile ranking in the market. So Amazon's got a lot of work to do to improve their earnings quality. The insiders are also selling. Percentile ranking of 24 tells you the bottom half of the market compared to the rest. There's a lot more insiders selling in Amazon than buyers, so to speak, at this point in time. But the analysts are upgrading the numbers, so you should start seeing some price improvements. Intrinsic valuation, the bottom 23 percentile rank in the market, so it's not a cheap stock from an intrinsic valuation point of view, nor is it on a relative valuation point of view. You can see there where the rankings are in Amazon. So I think it's probably one of the in terms of the earnings quality rank, there's a lot of risk in Amazon at this point in time with respect to earnings quality and valuation, as well as intrinsic valuation, bottom to 23rd percentile ranking. So these wraps up the StarMine rankings. Thank you for watching. Until next time, happy cloud chart and AI trading. Bye for now.